Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management e-News. Thank you for joining us on tax day. It's April 15th. So for those of you that owe taxes from last year or pay quarterlies, you still have to pay those today, but you have till May 17th to file your taxes. So not really sure why they did it, but they didn't ask me, so it is what it is. Today we thought we'd talk a little bit about the good news that we've been seeing in the economy, the good economic data we've been seeing in the economy. Josh is going to talk about earnings season so far, and really why that all of this good news in the markets and in the economy may provide somewhat of a headwind for some stocks going forward. So, as I said, we've been seeing a lot of good economic data. We know that people are getting shots in arms, and so the economy around the U.S. is opening again. Restaurants, people are traveling, all that kind of stuff is happening, and so there's this giant amount of pent-up demand in the U.S. economy, and that's starting to be unleashed, and so we're starting to see some inflationary pressure because of it. When you look at the economic data on the inflation front, we're starting to see, and then there's some supply chain issues, stuff going on around the world that is also contributing to inflationary pressure. So even though the Federal Reserve, the central bank of the United States, has talked about not raising interest rates through 2023, and the chairman of the Fed was on 60 Minutes last Sunday and talking about, well, now we at least won't raise them through the end of 2021. I think the market and the economy, there's a good chance that those two things force the Fed's hand. And so what that means is the Fed might have to, pump the brakes a little bit, not buy so many bonds. They're buying $120 billion worth of bonds per month in the bond market right now, providing tons of liquidity in the markets and the economy in general. And so if we start to see inflation, they might have to ease off on that, which then would make interest rates go higher. And a lot of these stocks, these high-flying stocks, growth stocks, would have to be repriced. But there's a lot of, earnings season just started, and Josh can talk about that. But I think all of this good news could provide some headwind because the Fed might have to act sooner than they were probably planning because, just the inflationary pressures that are building up in the system. So Josh can talk about earnings and also why that will affect markets too.
I must confess, I, along with probably a lot of other market observers out there, thought that we would see a bit of a sell the news type event as our earnings season in Q1 kicked off. Expectations are obviously sky high. And, again, we remind all of our clients constantly that everything in markets is relative to expectation. Here we are, the first week of earnings season, almost in the books, and earnings are blowing past what were already quite lofty expectations. Financials are essentially minting money in this environment, and you saw the world's largest asset manager, BlackRock, this week come out with $9 trillion in assets under management. Consumer staples have kicked off and been exceptional as well. So what you're seeing is stocks continue to shoot higher. The quite unusual phenomenon this week has actually been treasury yields have actually fallen a bit, which, relative to the outstanding economic data we've seen in the last couple of days and today's blowout retail sales number, not a phenomenon you would expect to see. Obviously, tech stocks, as Tyler mentioned, tech stocks have done really well off of that environment over the last couple of weeks, many of them in high single-digit returns. As earnings seasons continue, analysts were pricing in almost 25% year-on-year growth in S&P 500 earnings. The numbers coming in north of 30 in certain sectors. Financials, for instance, the expectation is for 75% year-over-year increase. Remember, comps aren't going to be so awesome as we sort of get past the malaise of the first quarter of 2020, but markets are going to continue to move higher, and it may be one of those self-fulfilling things where as the numbers continue to get better, that leads to significantly enhanced inflation expectations. We get a rise in yields and then another decline in multiples, so a bit of a stock sell-off. But here we are, and I must confess, as I highlighted at the offset of this segment, that I was expecting a bit of a sell the news type event, but earnings are blowing past what were already lofty expectations.
So I think what you need to remember is that we should experience some volatility. We don't know where that volatility is going to come from. We don't think you should make some sort of binary decision with your money, all in or all out. If you wanted to take risk off the table, now would be the time to do that with maybe a ratcheting down of your allocation to equities. We don't think that the future is awful for equities. We just have seen such a huge run for the stock market that we think that a breather is probably due. But if earnings continue to come in like they have, stocks can certainly trade higher on that news. So if you have questions about your situation, your account, anything that's going on with you, call our office to schedule an appointment. We're doing them in person or in the phone or Zoom, whatever you're comfortable with. The number here at the office is 800-743-0988. And we'll see you back here in 2 weeks.